Hello and welcome. You're watching KYC. I'm Hersh Sayta. Today we're going to be talking about Nazara Technologies. It's again an IPO which happened less than 5 years ago, and it's a company which had immense investor interest. Now the stock has rallied. It's done very well for itself. And therefore, we've picked this one up. Also, the FY25 numbers were quite good in comparison, and that's why we saw a decent amount of traction in the stock as well. Let's though quickly look at what I want to really look out for. The first thing is going to be the cash flow number. The cash from operations in FY25 is far lower than profitability or EBITDA or however one quantifies it. And therefore, that's my primary concern. Why is that so? And what is it that changes in the next year? Can some of these cash from operations get loaded into FY26? Is that a surprise at all? The second one is going to be the levers for growth. They generally make acquisitions and they do growth mostly through inorganic means. But can they grow organically in a sharp fashion will be the question. The third piece is with regard to the fact that you just have to have better margins in this business. Can margins improve? What are those levers that one will look for in terms of margins? Now, they also have introduced a new vertical, and I'll just take a minute to explain this. The sports media vertical, how large can it get? Because they might delink that from the current verticals that they have. So are we seeing a large vertical get delinked or not will again be the question. The margins of different businesses will be the other piece I'll want to know about, but they ventured into offline games. How will offline games really contribute to the overall margin picture as well as to overall top line? What's the goal there? Because that is more recent in terms of its business acquisitions. Now, in terms of long-term goals, of course, it's a gaming company and therefore will likely stick to that industry. But what's the long-term goal like? What are the numbers that they will look to clock? Because you're currently at 10,000 crore in market cap, and therefore, is there an opportunity for that to expand or not will be the question. They've made lots of acquisitions and that's how they grow. How do they continuously ensure monetization and efficiency of some of these acquisitions that they've made will be the last piece I'd want to really look out for. New acquisitions, what's the plan? How do they balance profitability with some of these acquisitions? Well, all of that and more when I speak with management. But first off, let's try and understand the business itself. This one was incorporated in 1998 by Nitish Mittersain, who is the founder as well as the current promoter of Nazara Technologies. It's a multi-million-dollar company now. It's diversified. It's got a global presence, and it's primarily into gaming. It's India's only listed gaming company. What it also boasts of is a global presence, which I spoke about. They continuously raise equity. That's also a possible concern for me, and that doesn't shape up well because you continue to dilute existing shareholders. How much of that is going to continue along with promoter stake sales will be the other thing I'd want to know. Let's look at the business now at a glance. You have all of these verticals within the company, but primarily the company divides itself into three verticals. One is the gaming vertical, the other is the esports vertical. Within esports, there's sports media and there's online gaming tournaments, and then there's the ad tech vertical. Most of these verticals grow or have been part of acquisitions. Gaming is the one which they have built organically, and now they use it for inorganic expansion as well. But other than that, largely it is acquisition led. Now, let me break this up a little bit more. Let's understand each segment. The first one is the gaming segment, and within gaming, it's the mobile gaming segment. They do these acquisitions. They've created a company within that, or rather, they have acquired the World Cricket Championship and the Big Bash Cricket, which are both games within the Next Wave multimedia subsidiary of theirs, and that's one of their investments. The other one is again mobile gaming, but they acquired this one called Curve Games in May of 2025. It's a London-based video game publisher. The acquisition is 250 crore acquisition, and it offers a higher margin revenue. So it's margin accretive for the company. It's got cross-platform expertise, and it's a global launchpad for Indian developers as well. So that's the other one which they've acquired recently. But this is the big one. They have a stake in PokerBaazi, which is moonshine technology. Now, PokerBaazi, you would have seen various ads, and this is the more familiar of the many businesses that Nazara runs. It has acquired a 48% stake for 832 crore in September of 2024. It's real money gaming, and this gives it a presence in that real money gaming segment. It's achieved the highest ever revenue in FY25, and of course it's boosted by campaigns within IPL and Shark Tank, which are the marketing campaigns that they run. They continue to accelerate user acquisition within this business. So PokerBaazi is the other big one. Then you have Paperboat Apps, which they acquired in July of 2024, gamified early learning segment with the Kidopia app. They have an app for kids to play children games. So that's the other one which is which they run. Now, talking about some of the offline games, you have Funky Monkey and Smash, which they have acquired in 2025. Funky Monkey, Smash is a full acquisition which they made under the IBC or the Insolvency and Bankruptcy Code due to issues with regard to the business. But Funky Monkey, they own 60% stake. It's an indoor soft play and entertainment center chain and caters to children. Now let's talk about esports. The business is extremely large, so I might take some time to go through it. The esports business, Nodwin Gaming is the other piece that they have a stake in. They own 55% majority stake in Nodwin Gaming. It's an independent subsidiary, a platform for growth is what they call it, and they plan to raise additional capital this month within Nodwin Gaming. It generally organizes esports tournaments. That's what they do. So again, an interesting play there. The other play that they have is in the sports media space, where they have Sportskeeda and Pro Football Network. Sportskeeda, as you well know, is the Indian platform which caters to cricket news predominantly, and then you have Pro Football Network, which is the equivalent platform in the US for NFL and the like. So those are also valuable in terms of assets that Nazara owns. And then you have the ad tech segment. Again, this is a niche. They acquired a majority stake in DataWorks, 55% stake, in January of 2022. That for 225 crore, it's aimed at enhancing customer acquisition capabilities. It works very, very well with the existing business of Nazara, which is acquiring customers for gaming. They do this now for other businesses as well. So therefore, that is the other synergy which they've tried to unlock through acquisitions. But now let's look at the rating parameters that we will be analyzing with regard to our Nazara technology. We'll start off with the income statement, the balance sheet, the cash flow, the shareholding pattern, and return ratios, street cred, street coverage, valuation, yeah, so you have all those 8 parameters that we look at. Let's start off with the income statement now. The last 3 years, the income statement has actually done quite well for itself. You've seen a 38% growth on the top line. The EBITDA has gone up by just 12% on a CAGR basis. Margins have shrunk actually. They've come under pressure. Can those margins go back will be the question. Profitability has also done decently well for itself on a 3-year CAGR basis. But over the last year or so as well, you've seen decent growth on that profitability metric. So keep your eye out on that. So it's clearly a positive with regard to the income statement, but look at the margin trajectory. I want to highlight that for you. From 14%, margins have come down to 7.5%. This is where the margin pressure has been acute. What they've done is they've made acquisitions, and some of these acquisitions are in loss-making businesses, and therefore what you're seeing is a margin drag from some of these acquisitions. As they plan to scale these acquisitions, you might see margins start to revive. The question is how much and how quickly. So that for that we will obviously speak with management. Let's break this up into segments. There's gaming, there's esports, and there's ad tech. 3 segments which they have. The gaming segment is out of the 1600 crore, roughly contributes a 30% to the top line. The esports segment is around 750 crore out of the 1600 crore, so it's a larger chunk. And remember, esports also has sports media within it. So not just Nodwin Gaming, but also the sports media segment. And then you have ad tech, which is fast growing from 103 crore last year in terms of top line. Ad tech has now contributed 350 crore to top line. So that is where the significant chunk of growth has come from this year. You want to look out for ad tech as the big new growth engine if it were to play out. Let's look at how the balance sheet though is shaping up. You're seeing equity base continue to rise because they make acquisitions. When they make acquisitions, they need to issue fresh equity. When you have to continuously issue fresh equity, you keep diluting existing shareholders. That's the key downside here. So you want to take care of that. But outside of that, the borrowing is limited on the balance sheet, as you can see. Equity shareholders' funds, or the book value of the entire entity, is roughly 3,000 crore. Just 200 crore rupees of borrowing. It's gone up in recent times, but they've also made acquisitions, especially the inorganic route to acquire offline games or gaming studios or gaming parlors like a Smash has added to that borrowing number. Look at the cash though, cash in bank sitting on a very healthy cash in bank balance of around 450 crore as well. So that looks okay. Balance sheet doesn't look like a concern per se, just the equity dilution is something you need to take care of. But outside of that, no risk here in a significant fashion, and therefore we've given it a thumbs up. Let's look at cash flow very quickly. Now, in terms of cash flow, this is where the concern lies. You look at the cash flow from operations at 65 crore. Look at the EBITDA number at 122 crore. That is not really adding up. The cash flow to EBITDA is not really adding up. So you want to wait and watch as to what's causing that drag. The net cash flow likely negative because of acquisitions that they make. I wouldn't be too concerned about the net cash flow. So therefore, we've given this a neutral. You want to wait and watch out for that. FY24, decent set, but FY25, not looking good. Let's look also at the return ratios now. You look at the way return ratios have shaped up, it's 2 to 5%. That doesn't look very appealing, right? You're seeing return ratios of north of 15% generally as part of filters that most investors make. This one with a sub 5% ROE and ROC doesn't really appeal. You want that ROE, ROC to inch up, and that's the other question that hopefully we'll get answers to. Now let's talk about the shareholding. The shareholding, again, a crucial part of this entire basket. The shareholding pattern has really just seen a downward trend where promoter shareholding is concerned, and this is a key thumbs down. Not only are they diluting, they're also selling stake. They sold a 6% stake to Plutus, for example, Plutus Wealth. I'm not so sure as to why that is so. We will ask and quiz promoters as to why they are continuously selling stake, but it's not a good sign regardless. From a 19% to a 9% in 2 years, well, it's not looking good. FI holdings have inched up a little bit, DIs have also inched up a little bit, but look at the public shareholding. The free float, 65% sitting in public shareholding. That's also not looking too good. So just from a shareholding standpoint, it's a major red flag, a couple of major red flags that we can see. Now let's look at street cred. Look at the way in which the stock has moved. 25% up 1 month, 6 months 21%, year to date 23%, 1 year 78%. So we've seen very strong moves, at least in the near term. And this is despite markets being tepid, especially SMID stocks from September, which haven't done well. Nazara is one that really stands out. And therefore, we've given it a thumbs up with regard to street cred. So that's one positive with regard to where street cred is concerned. Now let's look at valuations. In terms of EPS, the FY26 EPS is expected to be at 14 rupees per share. And FY27, that's expected to go to 19 rupees per share. That is significant in terms of growth. The price to earnings multiple is at 88 times currently, 1 year forward, is expected to shrink to 64 times. I'm thinking, even if the company were to execute in the best way possible, A 66 times 2-year forward price to earnings doesn't look cheap. I mean, it may be a growth-focused company. Revenues are going up significantly. Margins are also inching higher as per estimates. But there is no valuation comfort per se because there are no comparables. I cannot compare the valuation metrics, but versus the listing price, it's surely looking very, very expensive. And hence, I have given this a thumbs down. Let's talk about analyst ratings very quickly. You have 4 buy calls, 2 hold calls, 4 sell calls, a return potential of -6% as per Bloomberg. So there's actually a downside risk to this. Again, not looking good. I would at best give this a neutral, but what we're going to do is we're going to give this a thumbs down because a majority either are saying hold or sell. So therefore, we're tilted more towards the thumbs down. Let's quickly have a look at the ratings, therefore. We're looking at decent growth on the top line, and therefore income statement is decent. Balance sheet in terms of debt is largely de-risked. Cash flow, you want more of that to come through. Return ratios are a thumbs down. Look at shareholding, street cred, valuation, street coverage. Sums it all up. We give this a 3.5 on 8 on our KYC ratings. But can this change? Really is the question. And I want to bring on board Mr. Nitish Mittersain, who is the Joint Managing Director and CEO at Nazara Technologies, to talk to us about exactly that. Good morning, Nitish. I want to first start off by understanding from you what is the what's the drag with regard to cash flow in FY25? And I'm talking about cash flow from operations versus the EBITDA number. What's caused that drag? And can that reverse in FY26? And if so, how quickly?
Yeah, sure. As you saw in FY24, our cash flow conversion was close to 90%,
yes,
which to 54% due to some, I would say, delays in payment collections, etc. But we're very confident that FY26 will, the cash flow numbers will be higher. And we're generally quite a cash flow focused company. We look at all the cash flows being generated. We've always been a positive cash flow generating company. So I don't think it's a long-term challenge. FY26 should post better cash flow results compared to FY25.
Has that already reversed, Nitish, to a certain extent? We're already in FY26, so some indicators?
Yeah, I think we're seeing positive indicators of cash flow. We usually put out a cash flow in September results.
Right.
So you'll be able to hopefully see that.
Okay, perfect. How does the mix change, Nitish? Because you've seen very sharp growth in the ad tech vertical. Does that continue on this higher base?
I think so. I think, we've acquired another company called Space and Time based in the UK. And right now we see good synergies between our existing ad tech platform, which is DataWorks, and Space and Time, and the team is busy, building that out. So I think over the next year, you will see improving EBITDA margins from that business, which should add to our overall profitability.
How much would that improve, Nitish? What is it at currently? Give us that perspective. And where does it go maybe 1 year and if not 3 years from now?
Yeah, today the EBITDA margins on our ad tech business are, sub 10%. But I think over a 3-year period, we should be able to get it to a 15 to 20% kind of number.
That's on the ad tech business only, and therefore, what's the impact? That will be huge, Nitish. Where does your top line go? Give us more perspective.
I don't have a specific guidance out right now on top line. The only guidance we have out right now is that in FY27, we should be able to achieve a EBITDA of 300 crores. And we seem to be well on track to achieve that. That's up from a EBITDA of 153 odd crores in FY25. So we should double our EBITDA in the next 2 years.
Double your EBITDA absolute number in the next 2 years. Top line, difficult to guide as of today. But give us specifically for ad tech. You said 20% margin number in 2 to 3 years from now. Where does the top line go? I want to understand top line contribution, either a percentage or either a number. What's the target like?
Look, I think our focus in that business, as you can see, is already generating strong top lines. So I think we are not very focused on driving faster growth in that business in terms of just top line generation. I think after these acquisitions that we have done, remember that Space and Time, which has added a lot of revenue to our current base, is a company we acquired recently. Our whole focus is on, bringing synergies, getting some cost optimizations done and improving the EBITDA margins. So I think we would worry less about how the top line is growing there and focus a lot on how we can uplift the EBITDA margins to the levels I was speaking about earlier.
Okay. How confident are you of this 20% EBITDA margin number, Nitish?
Yeah, I said 15 to 20%. So
15 to
let's
20. Fair.
let's go to that
The
range.
journalist in me gets to me sometimes. But yes, 15 to 20, Nitish. Tell me.
Yes, I think the team is working hard
Sure.
and quite hopeful that we will achieve that.
Okay, fair. What about the other business verticals, Nitish? Are you going to split the sports media vertical? Does that create new levers of growth for it? Does it give it renewed focus?
Yeah, I think it's important to note that if you saw the presentation we put out at the end of the year for FY25 last month, I think we've kind of doubled down on our core gaming business because we're seeing the highest margins, the best cash flows, and potential to grow, and we are constantly acquiring very strong global gaming IP. Including in FY25, we've done multiple acquisitions in that space. So I think, at least from a capital allocation perspective, from a Nazara perspective, FY26 will be all about investing more in these gaming IPs and potentially acquiring additional gaming studios. The other businesses, whether it's the ad tech business or our esports business, are run by strong managements, are well capitalized, and are independently running businesses. So I think they will continue to grow in their own paths and own perspectives. But we are right now doubling down a lot on the core gaming business ourselves.
Nitish, you want to give perspective to our viewers with regard to what the thought process is. When you continue to acquire businesses, what's the thought process? What do you want to build out? And how you expect to scale? I mean, I've read a bit about it, but it's great to have your perspective. So give that perspective to viewers.
Sure. So, I think Nazara has built a very well diversified and stable gaming platform over the years. And we are well poised to, take advantages of two opportunities. One is the Indian gaming growth opportunity. The Indian gaming market is expected to grow the fastest in the world. We already have 500 million gamers. Monetization has lagged, but it is starting to pick up. So I think India will become a large revenue generating market in the gaming world over the next 5 years, and Nazara is best poised to take advantage of that. In addition to that, there is a lot of, I would say, opportunity of Indian gaming companies going global. And I think Nazara can be the first globally respected gaming company out of India. So I think that's what we are pursuing quite actively.
Nitish, do you intend to double down on existing acquisitions you've made or continue to grow through acquisitions?
I think we'll obviously do both. Post acquisition, post acquiring a company, obviously our focus is always on how do we scale that business. Done that quite often in the past. If you go back the last 4 5 years, whether we acquired Kidopia, which was about 20 crore revenue business when we acquired and took it to over 200 crores in 3 years, or a Sportskeeda when we acquired it was a 15 crore revenue business, which in FY25 has done over 200 crores of revenue with very high profitability. Nodwin Gaming was a 17 crore business when we acquired it 5 years back, which is today a 500 crore revenue business. So I think Nazara has proven time and again that the companies it acquires can grow, and they can grow profitably because we focus a lot on profitable growth rather than growth at all costs. So I think we are quite confident that the companies that we acquired will continue to grow. At the same time, I think it's a fantastic opportunity at this point of time for Nazara to expand further through acquisitions. We have very attractive opportunities. We have the right momentum and the right brand positioning globally for a lot of gaming companies wanting to partner with us. So we will definitely double down wherever we can.
Okay, point taken. Your return ratios, though, Nitish, have shrunk. This doubling of EBITDA, what does it do to your return ratios, and where would you want it to normalize? Because it's been a very long period of growth-focused capital allocation. When does that change to profitable capital allocation?
Yeah, I think it's important to note when you look at our return ratios, right, that because we have been a very acquisitive company, we absorb a lot of intangibles onto our book, and there is significant amount of amortization, intangible amortization that's happening below EBITDA. So if you look at our PAT numbers, right, our cash flows being generated are much higher than the PAT numbers, and therefore I think some of these return ratios are currently skewed and don't really tell the true health of our business.
Okay, Where does it go therefore, Nitish? What's the goal?
I think in the near term, we will continue to acquire large businesses, and therefore you may continue to see at PAT level return ratios remain depressed. Also, it's important to note that we've done large acquisitions. For example, in FY25, we invested nearly 1,000 crores in acquiring a near majority stake in PokerBaazi, which is the #1 online poker platform in India. Again, that is today not profitable, but an extremely fast growing market leader with about 30-40% market growth. We don't even consolidate those revenues in our books yet. So I think some of these ratios, because of multiple reasons like this, are skewed, and I would invite your viewers and investors to deep dive a bit into the numbers rather than look at them at a superficial level to understand the real health of the business.
Okay. Nitish, last question is with regard to promoter stake dilution. You've diluted some amount of stake. Give us the reason for that. And second, any further dilutions expected, both on the equity side as well as on the promoter holding side?
Sure. I think, of course, one reason of dilution has been, as you yourself mentioned, due to the acquisition opportunities, we have, raised equity capital, and that has led to some dilution. But I very strongly believe that the actions that we are taking in terms of dilution, and I know nobody likes dilution, but are very strongly accretive to the shareholders. And only that's when our intent is to do that. If we're able to increase significant value over and above the dilution cost of the fundraise. In terms of promoter selling, I think, the promoter family ran the business, for 25 years with very little liquidity. In the last year, we did, dilute a certain amount, sell a certain stake. But I think the whole purpose was to kind of be able to be more aggressive in the business. We were being a bit conservative, having run this business for 25 years. And we've been very happy to be vindicated by our biggest investors who have kind of bought the stake, right? If you see the stake that was bought from the promoter family, it was bought by the largest shareholder in the company, Plutus, which has been in the company for the last 5-6 years and understands the company well.
Yes.
So I think that was a strong vindication for us. As you also know, Plutus / Arpit Khandelwal, as well as the well-known entrepreneur Mithun Sacheti have of Carrot Lane have put out an open offer and are joining the company as co-promoters. So I think we are getting the right backing of the right investors. The Kamath brothers, led by Nikhil Kamath, have also taken a stake in the company.
Yes.
So I believe we have the right backing with the right investors. And we will continue to focus on making Nazara, like I said, a globally respected name in gaming out of India.
Okay, thank you so much, Nitish, for coming and speaking with us. Super having this conversation. Completely out of time as well, viewers. In fact, thanks so much for watching. More on the other side. Stay tuned to NDTV Profit.